Warren Buffett, the Oracle of Omaha, is known for his unmatched investment strategies and his ability to pick long-term winners. However, in a shocking move, he recently decided to sell off one of his most valuable investments. Stick around as we dive deep into the reasons behind Buffett's unexpected move. In the second quarter of 2023, Warren Buffett's Berkshire Hathaway sold 70% of its stake in Activision Blizzard, seemingly missing out on a potential profits after a federal judge approved Microsoft's $68.7 billion acquisition of the video game company. According to a regulatory filing made, Berkshire owned 1.9% or 14.7 million shares of Activision as of June 30 for a total market value of $1.24 billion, down from 6.3% or 49.4 million shares as of March 31. However, the price of any sales, or whether Berkshire purchased or sold Activision stock in July, was not covered in the filing. Additionally, an inquiry for comment was not immediately answered by Berkshire. Aren't you confused by the action made by Berkshire? Buffett saw investors as overly doubtful that regulators would permit the combination of Microsoft's Xbox gaming console company with the publisher of the Call of Duty and the Candy Crush franchises, so he saw the Activision investment as a type of arbitrage. Late in 2021, one of Berkshire's portfolio managers purchased Activision, and in 2022, Buffett increased the company's holding to about 10%. At Berkshire's annual meeting in April 2022, the billionaire told shareholders that while he was unsure whether authorities would approve the deal, which valued Activision at $95 per share, he added, "One thing we do know is Microsoft has the money." The amount of Activision stock that Berkshire still owns, 14,658,121 shares, is the same as it was before Buffett started purchasing, indicating that he's abandoned the arbitrage gamble. Activision stock climbed 10% to $90.99 on July 11 after US District Judge Jacqueline Scott Corley in San Francisco rejected FTC concerns that the merger would harm competition in cloud gaming, consoles, and subscription services. The Competition and Markets Authority in the United Kingdom also opposed the merger but agreed to stay on Microsoft's appeal to give them more time to resolve their disagreement. Why do you think Buffett was not convinced that Activision would get the deal done? Even though the stock prices of Activision had climbed to $90, there is something Warren might have seen on the fundamentals of the company. The mega merger hit snags in late April when UK regulators vetoed it, fearing it would impede innovation or decrease consumer choice in the cloud gaming business. The US Federal Trade Commission also blocked the agreement, but on July 10, a federal judge determined that it may go through, and UK officials have agreed to consider a modified plan. Activision stock has risen 11% this month to $93, less than 2% below Microsoft's bid price. Berkshire's most recent statement suggests that it cashed out of the majority of its shares last quarter, implying that it has mainly missed out on the stock's recent rise. During Berkshire's annual meeting this year, Buffett was asked if he had decreased or sold his Activision holding in light of regulatory objections. He replied while seated next to his business partner Charlie Munger, but went on to criticise officials for delaying the sale. He said, "I believe the British government is making a mistake here, but that's life in the big city," as Charlie would say. Buffett was asked whether he reduced his investment in Activision during the Berkshire annual meeting. He replied, "Well, in terms of what we do with stocks, I believe we only disclose information when obligated to do so, which is in the 13F or other documents we submit. However, there are some things you can really determine by looking at our 10Q, which we filed this morning, but only with considerable effort. I believe Microsoft has been remarkably, cooperative with governing authorities, if I may say so." He added the fact that they want to agree and have, in my opinion, more than met the opposition halfway, does not guarantee that it will be completed if a particular nation, in this example the UK, wants to block. He added, "I don't know how it comes out, but they are in a better position to stop it than the United States. That's simply how the world works. And it doesn't get fixed by offering more money. However, if it doesn't work, Microsoft or Activision are not at fault. However, not everything that ought to occur actually occurs." Additionally, Buffett said, "We ran into it when we made the deal with Dominion Energy 18 months ago, because they allowed us to buy a portion of what we wanted to buy. But then the US government effectively told us, you can't buy something else, which I think we would have handled better than anyone else did. The state's involvement and the customers didn't object, but you don't take on the United States government, so we try to come up with solutions so that you won't have a problem." He concluded, "I believe the British government is wrong in this instance, but I would argue that's just life in the big metropolis, and what we decide to do will depend on a variety of factors." So you are agreeing with what Buffett said? Do you know what a 13F filing is? All institutional investment managers with at least $100 million in assets under management are required to file the Securities and Exchange Commission's Form 13F every quarter. It reveals their equities holdings, can offer information about what the market smart money is doing. However, the SEC has acknowledged issues with the accuracy of the data on 13F filings. Within 45 days of the final day of the calendar month, managers must file Form 13F. Hence, the majority of funds will wait until the conclusion of this timeframe to keep their investment strategy a secret from rival funds and the general public. Do you know that there are some problems related to the SEC 13F? Smaller investors who desire to imitate the tactics of well-known money managers like Seth Klarman, David Tepper, or Daniel Loeb closely examine 13F filings. By examining changes and quarterly filings, the financial press frequently discusses what these fund managers have been purchasing and selling. However, there are several issues with 13F filings that call for caution. Numerous organisations have criticised 13F, claiming that it gives hedge fund managers a way around the rules. In reality, the SEC itself acknowledged the form had numerous issues in a statement from 2010, and that a number of adjustments had been made to guarantee useful and verifiable data is delivered to the public and government regulators. Additionally, a further finding from the SEC's internal study was that despite the SEC would be expected to make extensive use of Section 13F information for regulatory and oversight purposes, no SEC division or office conducts any regular or systematic review of the data field on Form 13F. Another major criticism is that the form sometimes only requires fund managers to submit 13F reports 45 days after the end of each quarter. Most managers submit their 13Fs as late as possible to avoid alerting competitors to their plans. Other investors may be looking at stock purchases that were made from more than 4 months before the filing by the time they get their hands on those 13Fs. Another reason is the herd behaviour. The propensity of money managers to steal investment ideas from one another poses a risk for both professional and retail investors. No one is immune from behavioural biases, including hedge fund managers, which means that being wrong with the majority is actually safer for fund managers than being wrong alone. Hence, overvalued stocks and crowded trading might result from this. Additionally, tiny investors who are tardy entering a trade are probably also tardy exiting it, which is creating a lot of criticism for the 13F form. Finally, the form as a whole looks incomplete. Another problem with 13F filings is that, in addition to their put-on-call options, American depository receipts and convertible notes funds are only required to record their long positions. Since some funds are employ long holidays as hedges and instead derive the majority of their earnings from short sales, this might present an incomplete and even misleading picture. Hence, these hedges cannot be distinguished from actual long positions on 13F forms. Hence, for a form that is receiving a number of criticisms, the approval given by them can become worse. Buffett might have seen this at the earliest and decided to sell off Activision's stock, but as you can see, Berkshire still holds 30% of Activision stocks, which means they still believe in the growth potential of the company. So what do you think? Did Buffett make a mistake by selling off 70% of Activision stocks, or was it a wise decision? Only time will tell. Let's wait and see. And there you have it, folks, an in-depth analysis of why Warren Buffett decided to part ways with one of his most valuable investments. But what if I told you there's more to this story than meets the eye? Behind every financial decision, there's often a hidden lesson that we can all learn from. Before you go, don't forget to hit that like button, and if you found a value in today's content, what are your thoughts on Buffett's move? Do you agree with his decision? Share your insights in the comments below. And if you haven't subscribed yet, make sure to hit that subscribe button to stay updated with the latest analysis and deep dives into the financial world. Till next time.